Brent Freeman with the CBB Group. In this episode, we're going to examine how the interest rate environment has affected the value of small businesses. So we're going to take an example and work through the last 18 months and maybe where interest rates are going. And I think you'll be surprised to find out that although interest rates have risen, they haven't affected the value of small businesses as much as one might expect. So if you're a buyer or a seller, stick around because I think you're going to find this episode fairly helpful. As we go through this presentation, if you've got questions, please feel free to drop me an email or leave them in the comment section below. And as always, if you find this video helpful, hit the like and subscribe button, and with that, let's get started. For purposes of this presentation, we're going to start off with a purchase structure of a $1 million business, a 10% down payment of $100,000, and a seller note of 5% or $50,000 with an SBA loan of $850,000. Now we're going to take a look at kind of where interest rates were, say at 6%, take a look at a current interest rate of 10%, and where interest rates may go with the Fed's continuing to promise at least 2 more rate increases by the end of the year of 12%. So the key metrics that we're going to look at when we go through each one of these interest rate environments is the debt coverage ratio, the net cash flow after acquisition financing, and a return on investment. So with that, let's get started. To set a baseline, let's take a look at where interest rates were 12 to 18 months ago. And for this example, we're going to use 6% on a $1 million purchase and an $850,000 SBA loan with a seller note of $50,000. Now, the first ratio that we want to take a look at is the debt coverage ratio. So using the numbers from this example, you can see that the SBA loan is $9,436 a month, the seller note of $555, and the owner's compensation of $100,000 turns out to be $8,333 a month. So if you take and add all three of those, you come up with a number of $18,324 minus, take it away from the seller's discretionary earnings of $31,250, and that gives you a net cash flow after debt service and an owner's comp of $12,926, or a debt coverage ratio of 1.7 to 1. And then when you run the return on investment numbers, you have a return on investment year one of 34.47%. So taking a look at that structure, you can see that not only are the banks going to be happy, the buyer should be happy, and in this instance, the seller was getting a multiple of 2.67 on the seller's discretionary earnings, which was pretty much market at that point. Now let's go to example number 2. In this example, we're going to use current interest rate, which is about 10% for both the SBA and the seller's note. And let's rerun the numbers and take a look at what we come up with. On the debt coverage ratio, you can see that the net cash flows dropped by about $2,000 to $10,912 a month, which still isn't bad. You have a debt coverage ratio of 1.54 to 1, which is above where most lenders today are requiring the debt coverage ratio to be. And you've got a return on investment of 13.52%. So overall, not bad, but it's obviously a decrease from where you were with interest rates being 6% if you're the buyer. So let's take a look at where interest rates could go in the next 6 months, and I think this is probably where they may peak out. Let's take a look at where interest rates may go, and this is, in my estimation at least, where I think they may peak, which would be around 12%, and that's for acquisition financing through SBA. So let's rerun these numbers and first take a look at our debt coverage ratio. So obviously both the SBA loan and seller note continues to increase. The owner comp remains the same. It gives us a total of $21,245. The seller's discretionary earnings of $31,250. And that gives you a net cash flow after acquisition financing and an owner's comp of around $10,000 a month, or a 1.47 to 1 debt coverage ratio, which is a little less than what most of the lenders are currently looking for. When you go over and rerun your return on investment, that falls to 4.08, which is starting to be on, probably pretty unacceptable. So we've walked through kind of where we were, where we are, and where we may go. Let's take a look at kind of where I think the effect on the valuations has come just by running the numbers. So again, the question we're trying to answer is, has the interest rate environment had an impact on the value of a small business? And I think that, you can go through those numbers that we've done in the previous 3 slides and kind of go, it probably has had somewhat of an impact. Okay, how much? Well, when I take a look at kind of the return on investment criteria that I think most buyers are going to look for, there's been about an 8% decrease in value of small businesses. Everything remaining the same, cash flows not changing, just on a static theoretical basis. So let's kind of walk through how I came up with that number and take a look at a new purchase structure. So using that 8% discount, let's rerun the structure of the transaction. So in this case, you go from a purchase price of $1 million to $920,000. The 10% down payment would be $92,000. The 5% seller note would be $46,000. And the SBA loan would be $782,000. Now we're going to run this at the worst case scenario of 12% interest. So if you take a look at the debt coverage ratio, that increases the debt coverage ratio back over the 1.5 to 1 to 1.55, gives you a net cash flow after acquisition financing and owner's comp of $11,000, and gives you a return on investment of 24.18%. So on a worst case scenario, the increasing interest rates have probably put pressure on the valuation of a business by about 8%. And of course, not all businesses are created the same, and not all buyers are looking at the same things. But just on a theoretical basis, I think you can say that 8% is probably about the number, which to me, I don't think is that bad, given that we've almost doubled interest rates over the last 12 to 18 months. But with a buyer and a seller working together, here's a structure that gives a buyer the proper rate of return and the seller the same $1 million. There's an old saying, and that is, no two buyers are the same, and no two offers or structures are ever the same. So thinking about that, let's try and be a little bit creative and restructure the $1 million purchase. So here we've got a $1 million purchase price, 10% down payment, but we've increased the seller note to 30% or $300,000, and then are asking the seller to take a 6% interest. So if you rerun the numbers given that structure, you're able to get a net cash flow of just under $11,000 a month, a debt coverage ratio of 1.54 to 1, which is totally acceptable to almost any SBA lender that I know of, at least in the market, and a return on investment for the buyer of 16.74, or just under 17%. So I think we've been able to kind of solve a little bit of a problem, giving the seller what they're looking for, which was $1 million. They've got to participate in the transaction to the tune of $300,000, but they're getting a 6% return on that investment. And then the buyer is getting what they're looking for, which is a decent return on investment and a very comfortable DCR. So let's go back to the original question that we asked when we started this presentation. Has the increased interest rate environment put pressure or affected the value of small businesses? And I think you can see that there is some pressure, but by being creative, you can solve some of those problems and still put together transactions that are good for both the seller and the buyer without decreasing the valuation of the businesses. So with that, I hope you found this video helpful, and if you have, please hit like and subscribe, and we'll see you on the next episode.